Stop scrolling. Today is Jerome Powell's last day as chair of the Federal Reserve. And I know you've been watching this closely. You follow the Fed. You know what interest rates mean for your savings, your retirement account, your real estate. You've lived through 2008. You watched what happened when the Fed got it wrong. So when I tell you that today, the same day Powell walks out the door, the wholesale inflation number just came in at nearly triple what Wall Street expected, I need you to hear what that combination actually means. Because it's not just a headline, it's a signal, and most people are going to miss it completely. Stay with me, because by the end of this video, you're going to understand exactly what's happening, and the only honest answer for where your money needs to be right now. If you've been paying attention to the markets lately, something probably feels off to you. The S&P 500 was down 7% at the end of March. 6 weeks later, it's up nearly 9% for the year. That's a 16-point swing in a month and a half. At the same time, gas is running over $4.50 a gallon. Groceries are creeping back up. And the inflation number you probably saw in the news this week came in hotter than expected. Again. So you've got this situation where your investment account looks okay on the screen, but everything you actually buy costs more every month. Both of those things are real. And that tension, markets up, purchasing power down, is exactly what I want to break down today. Because there's a name for what's happening. Wall Street's been using it quietly for the last few months. Bloomberg ran a piece on it 2 weeks ago. BCA Research, one of the most respected macro firms in the world, just issued a warning about it. It's called a melt-up. Here's the thing. You're not going to find a textbook definition for a melt-up. It's not a formal economic term. It's market language for something that has happened before, multiple times, and it always ends the same way. A melt-up is when markets surge, not because the underlying economy is genuinely healthy, but because money has nowhere else to go. Fear of missing out takes over, and prices detach from reality. It feels great on the way up, until it doesn't. The question is whether what's happening right now is different, and I think it is, in a way that changes the outcome entirely. Let me show you why. Because once you see the historical pattern, you can't unsee it. Let's go back to 1927 to 1929. The economy looked incredible on the surface. Unemployment under 4%, companies growing. The Dow doubled in the final 2 years. People were buying stocks on margin. You put up $10 and borrowed $90 to buy $100 worth of stock. What was inflation doing during that melt-up? Near zero. Prices were actually falling slightly. People felt rich. Nobody was worried about the cost of living. That sense of stability, that confidence, is exactly what gave people permission to speculate. Then the Federal Reserve raised rates to cool things down. The market crashed 89%. The Great Depression followed. Now let's move forward 70 years, 1997 to 2000. The internet was real, the technology was real, but the valuations were completely disconnected from reality. The NASDAQ rose 400% in 5 years. Companies with no earnings, no revenue, just a .com in the name, were worth billions. What was inflation doing? Around 2%. Low. Stable. People felt comfortable speculating. The Fed raised rates. The NASDAQ crashed 78%. $5 trillion in wealth, gone. Now the one you remember most clearly. 2003 to 2007. Easy credit. Housing prices going up 20% a year in some markets. People treating home equity like an ATM. The whole system levered up on the idea that real estate only goes one direction. What was inflation doing during that melt-up? 2 to 3%. Still felt manageable. The Fed raised rates, the housing market collapsed. 2008. Are you seeing the pattern? Every single one of those melt-ups happened with inflation near zero or mild and stable. People weren't worried about purchasing power, so they speculated. That psychological comfort is the fuel that drives a melt-up. Now here's where today is completely different. We have a potential melt-up forming. The market just ripped 16% in 6 weeks, but inflation is already running at 3.8% and accelerating. This has never happened before in any of the historical comparisons, and it changes everything about how this ends. And the number most people didn't catch this week? The Producer Price Index, PPI. That's the wholesale price level. What businesses pay before those costs get passed on to you at the store. Think of it like a pipeline. PPI is what flows in at the top. CPI, the consumer price you feel at the grocery store, is what comes out at the bottom. 3 to 6 months later, April PPI just came in at 1.4% for a single month, nearly triple what Wall Street expected. On an annual basis, 6%, the highest since December 2022. And here's what most people missed in that number. It wasn't just energy. It wasn't just the Iran war pushing gas prices up. Services jumped 1.2% in a single month. Wholesaler margins hit the largest monthly advance on record. That's not a war story. That's a structural story. Prices are rising across the board at the producer level. In 3 to 6 months, that hits your wallet hard. If you know someone who needs to hear this today, share this video with them. That's how this channel grows. Now here's where Kevin Warsh enters the picture. And this is the part I really need you to pay attention to. Today, literally today, Kevin Warsh becomes the new chair of the Federal Reserve. Powell is out, Warsh is in. And during his Senate confirmation hearing last month, Warsh told lawmakers he wants to change how the Federal Reserve measures inflation. Let me say that simply. The most powerful banker in the world wants to change the ruler, while prices are still rising. Here's what he's proposing. Right now, the Fed uses something called core PCE, consumer spending minus food and energy, running around 3%, well above the 2% target. Warsh wants to switch to a trimmed mean. You strip out the most extreme price changes at both ends, and what's left is what he calls the underlying inflation rate. Under his preferred method, inflation today reads closer to 2.3% instead of 3.8. Now, I'm not here to tell you whether that's right or wrong economically, but here's what I can tell you. Warsh was chosen by a president who has publicly called for rates at 1% or below. The US government is carrying debt at 120% of GDP. Every 1% increase in interest rates costs the federal government roughly $300 billion in additional annual interest, money we don't have. So what does it mean when the new Fed chair prefers a measurement that shows inflation nearly a full percentage point lower than the official number? It means the motivation to cut rates, despite the data, is enormous. One respected analyst put it perfectly this week. He said, Warsh wants room to reduce rates, but the inflation data simply does not give him that space without credibility risk. That is the box. That is what's different about this moment compared to every melt-up in history. In 1929, 1999, and 2007, the Fed had one job: kill the bubble. They raised rates, it was painful, but they could do it. Today, the Fed has two jobs that directly contradict each other: fight inflation and protect a government that cannot afford high rates. You cannot do both. The math won't allow it. And that's exactly why this melt-up, if that's what this is, ends differently than any of the ones before it. So what actually happens from here? I'm going to give you the honest two scenarios, because I'm not going to pretend I know exactly how this plays out. Nobody does. Scenario 1. The melt-up ends fast. Warsh uses the trimmed mean to justify cutting rates despite hot inflation data. Liquidity floods back in. AI stocks go parabolic. Bitcoin potentially surges toward new highs, and then a shock event hits. A credit crack, a war escalation, a single earnings miss that breaks the narrative. The whole thing unwinds quickly. Markets down 30, 40, 50%. Bitcoin potentially pulls back hard, maybe toward $40,000. Scenario 2. The slow bleed. The Fed stays frozen. Can't raise because of the debt. Can't cut because inflation is too hot. Markets drift higher while inflation quietly eats your purchasing power from underneath. Your retirement account number looks fine on the screen, but what it actually buys, less every year. No Black Tuesday moment, just a slow, grinding erosion that most people never see coming until it's too late. Here's what both scenarios have in common. Cash loses. Sitting in a savings account earning 4% while inflation runs at 4 to 6% is a guaranteed slow loss. It feels safe, it isn't. You already lived through what inflation does to purchasing power. That's not over. So, where does the logic lead? Two asset classes. And I want to be clear, I'm not starting with these. I'm arriving here because the evidence points here. Real estate. Real estate is a hard, scarce asset. They're not making more land. It produces income in the form of rent. And in an inflationary environment, if you have a fixed rate mortgage, inflation works for you. Your debt gets inflated away while the real value of the asset holds or grows. Now, real estate at today's prices isn't necessarily a bargain, but real estate at a discount, a motivated seller, a market that's pulled back, a property others are overlooking, that's a different conversation. You're not chasing the melt up, you're positioning below it. Bitcoin. I'm arriving here last because this is where the logic ends up, not where it starts. Bitcoin tracks global liquidity more closely than almost any other asset on Earth. When central banks cannot tighten the way they need to, when governments are trapped by debt and inflation simultaneously, liquidity stays loose. That is Bitcoin's environment. And the global demand for neutral, borderless, politically independent money is growing. Countries under economic pressure, institutional capital with nowhere else to go. The evidence keeps pointing the same direction. Could Bitcoin drop to $40,000? Absolutely. In a fast unwind, it can fall hard and fast. But in a melt-up environment where the government is printing its way through the debt, that $40,000 Bitcoin is not the end of the story. It's the setup. So here's exactly what I'm watching, and what I think you should watch. Signal 1. June 11th, the next PPI release. If May PPI comes in hot again, above 5% annually, that is not a war story anymore. That is structural inflation building in the pipeline. And it confirms that what businesses are paying today will hit your grocery bill by fall. Mark that date. Signal 2. Warsh's first FOMC meeting. Watch whether he references the trimmed mean to justify a more dovish stance, even with headline inflation running at 3.8%. If he does, that's the green light. The melt-up accelerates. Liquidity comes back in. If he holds, we get more time. But either way, watch his language around how he describes inflation measurement. It will tell you everything about which direction this goes. Signal 3. Bitcoin below 50,000. If you believe the thesis, and I've walked you through every piece of the evidence today, any significant pullback toward 40 to 50,000 is not a crisis. For the person who understands what's driving this, that's the signal. That's the setup, not the disaster. The people who get hurt in a melt-up are the ones who chase it at the top, panic at the bottom, and sit in cash thinking they're being careful while inflation grinds them down. Position in scarce, income-producing, inflation-resistant assets before the chaos, and hold. Here's what today was really about. Powell walked out the door on the same day wholesale inflation came in nearly triple expectations. A new Fed chair takes over who wants to measure inflation differently so he can cut rates the government desperately needs. and the stock market is near all-time highs, while your purchasing power erodes. We've seen versions of this before: 1929, 1999, 2007, but never with inflation already in the room, and never with a government carrying this much debt. The outcome is different this time, and the honest answer for where your money belongs is real estate at a discount and Bitcoin. Not because they're exciting, but because the evidence leads there. I've linked resources in the description below that go deeper on the liquidity connection and what PPI historically signals for consumer prices. Worth reading before June 11th. Next video, I'm breaking down what Warsh's first moves as Fed chair actually signal for your mortgage rate and your retirement account. And one thing in the data surprised even me. Subscribe so you don't miss it. I'll see you in the next one.